Hello everyone, and thank you for joining me in today's educational webinar. So finally it's time for some education. Today is basically Friday, the 11th of October 2024. It's Friday, the end of a trading week almost. So yes, I thought maybe we could use some time to talk about learning something new. And basically this webinar today, okay, it's a standalone webinar. So if you didn't actually join us in the previous webinar, which was for the supply and demand, you can still attend today and you will be able to get some very useful insights about something that I'll be talking about today, which is the squeeze momentum. However, if you actually attended the previous webinar, supply and demand, and today the squeeze momentum, you will be having a really powerful strategy overall, because during the previous webinar we talked about price reversals and supply and demand zones, how to know exactly when a certain trend is about to reverse and so on. And today we're going to add something a little bit more to the same strategy, which is momentum. We'll talk a lot about momentum and the uses of momentum in trading. Someone says today is my birthday. Happy birthday from me and from all of our PU Primes family to you. Wishing you all the best. Okay, so today's webinar is regarding one indicator. The indicator is called the squeeze momentum. It's one of many momentum indicators out there. But I have been using this specific momentum indicator for as long as I've been, maybe for the last 4 years or something. I've went through a lot of momentum indicators. I've went through the RSI, the MACD, the momentum, the rate of change or the ROC, and a lot more. However, why did I leave all of the other momentum indicators and just focus on the squeeze momentum is something that you will definitely get to understand today when we talk about how powerful this momentum indicator is basically. Okay, today's webinar could be really difficult, okay, because the indicator is not so easy. It's a lot of calculations, and I'll tell you why exactly. However, because my job is to make things easier for you, I have disregarded a lot of the calculations that you will not really need in order to use the indicator on the chart. So yes, I'll tell you exactly how this indicator is calculated, but I didn't include it in the slides. If you want to write it down on a piece of paper, get a piece of paper ready beside you right now. If you want, I will say it. However, if you don't really want, a lot of headache on how to calculate this specific indicator, what's the use and so on, I will just dive through into the uses directly with no any further ado. So yes, I'm really excited. Thank you so much for joining me today, and I'll tell you something. How would this webinar go? It would basically be divided into, let's say, 3/3. The first third of the webinar will be purely theoretical on the presentation, and the remaining 2/3 of the webinar will actually be on trading view, or on, practical side. We will check the indicator and we will know how to use it on the price charts, because if anyone from today actually attends my weekly analysis webinar, you will know that I use this indicator a lot. So today I'll tell you exactly how to use it, how I personally use it, what other uses are there for the same indicator that I don't really focus on. So yes, buckle up, because it will be maybe around 1 hour or a little bit more than 1 hour if you have some questions, but it will be really useful for you to focus with me right now. So yeah, dive deep into the momentum indicator with me. And before discussing this specific indicator and before discussing this squeeze momentum thing, I want to explain to you, what does even momentum mean? I'll tell you something. Just don't focus on the slides right now, okay? Momentum is the third dimension of the chart. It's the 3D part of the chart. What do I mean? If you open any chart, whatever this price chart is for, you will find that you have price and time, right? There is a date or time, which is usually on the x-axis, and you have the price, which is on the y-axis. So the chart, any price chart, will give you the price moves as time passes by, which is really normal. So you have two dimensions that you can see on the chart, which is time and price, which is the x and the y-axis. However, momentum is something that you won't really see really easy. I mean, if you have experience, you will know how to spot momentum really easy with your eye. But if you're still learning momentum, so it's the third dimension that you don't really see on the chart, but it's another type of information that it's really important. Momentum is the speed of price changes as time passes by. Let me tell you something. If I'm telling you that gold price, let's give an example on gold price. If today an ounce of gold basically went higher, so as we speak right now, gold is trading at let's say $2,650 per ounce, 2650. Let's say today gold price went higher $50. So it went higher from 2650 to 26 or 2700. Okay, from 2650 to 2700, that's a $50 increase. Prices went higher. However, it's really different from if prices went only $10 higher, from 2650 to 2660, right? So in both cases, prices went higher. But in the first scenario, prices went higher by a $50 per ounce in one day. The other scenario, during the same one day, 24 hours of trading, prices went higher only by $10 per ounce. So prices are moving higher in both scenarios, but the first scenario, it's moving higher quickly, moving higher faster. So somehow the speed of how prices change, whether higher or lower, is how we know the purchasing power and the bullish power behind those price moves, because there is really a big difference whether prices are just moving higher slowly with zero or low momentum, and that's when we start using the word momentum instead of speed, because if prices are moving higher quickly, this means that there is good momentum behind prices. People are willing to buy a lot of gold today, and that's why there is strong momentum. The other scenario is, okay, prices are moving higher, but slowly moving higher. The speed of prices are not so quick. So we are just, moving up $1, $2, and so on. So yes, prices are moving higher as time passes by, but the price is really, the momentum is really low. And that's what I'm telling you. Normally, when you have a price chart, you have the time and you have the price and you have the time. The third dimension is, how does price change as time passes by? What's the speed of the price? This is momentum. This is the third dimension, and it really tells you a lot. Why? Because if you want to go, I know, everyone in the technical analysis field will tell you the trend is your friend, right? It's supposed to be your friend if the trend is just starting. And if the trend is really powerful, if people a lot are buying gold with good momentum, yeah, I want to buy with them. So only in some certain cases, I will join this trend because the trend is my friend. However, in other scenarios, even if prices are going higher, but I can see that it's not really powerful. The momentum is not so high, momentum is low. That's when I should take a step back and say, okay, is this trend really my friend, or should I wait for a reversal? Because you know what, trends are your friends and so on, but it will come to a point when trends reverse. And we see this on a daily basis in the markets. I mean, on the 1 minute time frame up to the daily and weekly time frames, you will see that trends are not to continue. Trends will reverse at some point in time. So how do you know whether this trend will continue or this trend is about to reverse? By measuring the power of the trend, by measuring the momentum of the trend. And this is why I'm telling you, momentum, it has served me really well in markets. It's the third dimension. You must start noticing the momentum after this webinar. Hi, sorry you came a little late. It's fine. Okay, so what is momentum? Momentum is, in financial trading, refers to the rate at which the price of an asset is moving in a particular direction, whether upward or downward. Because we gave a lot of examples on the price moving higher with good or weak momentum. On the other way, if prices are going lower, if we have a downtrend, will this downtrend continue? So we should short sell, or this downtrend will reverse soon. It also depends on the momentum of the power and the power of the move lower. If prices are moving lower with powerful moves, with fast speed and fast momentum, only then we can say that yes, this downward trend should be our friend, and that should be we should be shorting this instrument, whatever it is. Or on the other hand, if prices are moving lower with low speed, not so good momentum to the downside, only then we can say, okay, wait, because this might reverse higher. So it actually works both ways, higher and lower. So it measures the strength or weakness of a price trend. Let me just follow with me. Yeah. So it measures the strength and weakness of a price trend. Momentum is based on the principle that once a trend is established, it's more likely to continue in the same direction than reverse if there is good momentum, especially in the short term. So momentum helps traders understand whether there's sufficient force behind the trend, aiding in decision making about whether to continue with a trade, exit, or look for a reversal opportunity. And yes, it can tell you whether to jump into this trend or not, but personally, I don't use it so much in entering a trend following trade. I very much use it to look for reversal opportunities. Remember when we spoke about the supply and demand in the last webinar, I told you that supply and demand are price zones when prices will actually reverse. How can I know if this supply zone, let's say prices are moving higher and we have a supply zone, how will I know that prices will reverse when we touch this supply zone? In addition to having my supply zone on the chart, I want to see prices weak as they approach the supply. So yes, prices are moving higher to touch my supply zone. But if price momentum is showing some weakness, only then I will know that yes, once we encounter some sort of resistance or supply, prices most probably will reverse. And the same other way around if we're dealing with demand. So anyway, I'm telling you that as prices approach critical areas of interest, whether they are supply or demand, whether they are support or resistance, whether whatever areas of interest you have or technical levels you have on your chart, how do you know that prices will actually break through those levels, or would we respect those levels and turn the other way around? You will know by focusing on momentum. Okay. How to use momentum in trading? Number one, as we said, it's to identify trend continuation. When an asset's price is trending upward or downward with strong momentum, it often signals that the trend is likely to continue because we are moving higher, momentum is great, more people are buying, more money is coming into this market on the buying side, so more bullish traders, whatever you want to call it, but there is momentum there. So the trend is likely to continue if the trend is higher. And the other way, if prices are moving lower, a lot of people are maybe panicking or they are just selling. They are, giving their share of this item back to the market. I'm selling, I don't want this. If a lot of people are doing this, so you have powerful momentum, but on the selling side. So this means that most probably this trend will continue. Traders can use momentum indicators like the moving average, convergence, and divergence, which is the MACD. It's a very, very common and popular indicator, which is the MACD. you have the momentum indicator, you have the relative strength index or the RSI to confirm the strength of the trend. And let me tell you something really important here. And this is basically not within my material. I didn't prepare for this, but it just came through to my mind. A lot of mistakes that I see traders, especially beginner traders, do is that once they open a chart, they know that the MACD is a powerful indicator. They know that the RSI is a powerful indicator. They know that momentum, there is an indicator that's called momentum. They know that those indicators are powerful. So they just open on their chart all of those indicators, and they actually think that if they have, let's say, a sell signal on the three of them, this confirms that actually prices will go lower. I mean, some traders, beginner traders, they tell me, okay, I shorted this instrument. Why? Because it gave me a sell signal on RSI, on MACD, on momentum, and on the rate of change. Don't do this, because at the end of the day, momentum indicators, I've explained to you the idea behind momentum, right? Whatever indicator you use, it's still somehow a momentum indicator, right? The difference is a brief difference in the calculation. So I personally believe that the indicator that I'll be explaining to you today, which is the squeeze momentum, has some sort of an advantage because of how it's calculated. But at the end, mostly, if you have a sell signal because of momentum, you will see it most probably on the RSI, on the MACD, and all of the momentum indicators. It doesn't really mean that this confirms your bias. It means that you have something that we call as the confirmation bias. I'm looking for more information to confirm my idea, which might be wrong, because come on guys, at the end of the day, it's not the holy grail of trading. Momentum can and will deceive you sometimes, and it's your job to know when to follow momentum and when to not, and I'll tell you today. What I want to say is, you have a lot of momentum indicators out there. Today I'll be explaining one of them. I personally, based on my experience, very humble experience, I'm telling you it's the best, which is the squeeze momentum. You take what I'll be giving to you today and go out, look for the RSI, study everything else. If you want even me to do other webinars regarding all of those momentum indicators, I will. But my point is, you will not be using all of them. Choose the one that suits you and just follow one, because having more signals on more momentum indicators, it's not confirming your bias. It's not increasing your probability. It's just giving you a confirmation bias, which is really bad, okay? So yes, traders can use momentum indicators like this and this and this. Doesn't mean you should use all of them all together, okay? So the first use of momentum in trading is to identify the trend. However, this means that the momentum should be strong. It would tell you that this trend will continue. The other scenario or the other use is to anticipate potential reversals, which is the other way around, because you only have one of two scenarios. Is momentum strong? If this is a yes, so the trend most probably will continue. If momentum is weak, will the trend continue? No, most probably we will be looking for a reversal. That's pretty very simple. So momentum indicators can reveal when the current trend is losing steam. If the price is making higher highs, but the momentum, okay, there is a word here that says divergence. And we will have to talk a lot about divergence, because guess what? You know, all of the technical indicators in the market are lagging indicators. Whatever the indicator you're using is, it will always lag the price. Why? Because simply the whole idea of technical indicators is when price moves, this price is used in any sort of calculation to give you an outcome for the indicator, which means that any indicator should wait for price to move first in order to digest this new moves in the calculation and then give you a signal. So there is always a lag between price moves and the technical indicators. However, the divergence, which is this very simple word here, divergence, is the only leading indicator in the market. It will give you the sell signal before prices move lower. It will give you the buy signal before prices move higher. And yes, it's the only leading indicator in the markets. How is that? Let's discuss momentum divergence. Pretty simple. Divergence happens when prices are behaving in a way and momentum indicator is behaving in another way. That's when you know that, okay, prices are moving higher, but momentum is moving lower. What does it mean that prices are moving higher and momentum is moving lower? It means that even if prices are rising, momentum is lowering, it's decreasing, so the steam of the trend will not continue. The trend is losing steam. So prices are moving higher, but momentum is moving lower. This means that there are no enough buyers right now to support the continuation of this upward move, and this is why, and this is when we must start, to anticipate a reversal in price. So this is the divergence. It also happens the other way around. If prices are moving lower and momentum is starting to build, on the opposite side, you can see that on the momentum prices are starting, or on the momentum prices, momentum indicator is starting to move higher. So this means that, okay, this downward move and the momentum indicator is showing a little bit of inconsistency. And this is when you know that, well, what I'm seeing right now might be something wrong. And this is the only thing that I'm telling you, it actually comes before the price move. Okay, guys, I can see some questions here. Please just keep the questions right now, because I'm not telling you this is a tough material to digest, but I just need to focus 100% to make sure everything is delivered, and then we can have time for the questions. So divergence is when you have price moves in a certain manner and the momentum is behaving in another manner. What if they are moving together? What if you have another scenario where prices are moving higher and momentum is moving higher? Okay, that's good. That's confirmation, or that's what we call as convergence. The indicator we just spoke about, which is the moving average, right? Convergence and divergence. So convergence means somehow confirmation that momentum is behaving like price, which is good. But it doesn't really give me some sort of trading entries. It just confirms that I'm on the right side. The other which is the divergence, is the one that I want to talk a lot about, because this is really powerful. So the momentum divergence is when you have discrepancies between the behavior of the momentum indicator, whatever the momentum indicator is. So today we will be applying divergence on the squeeze momentum. However, you can apply it on RSI, and it's powerful. You can apply it on MACD, and it's powerful. You can apply it on momentum. Any momentum indicator has this option of divergence, and it's powerful. Okay, so momentum divergence occurs when the price of an asset and a momentum indicator, any momentum indicator, such as RSI, moving average convergence divergence, which is the MACD, or the momentum indicator itself. So the price of an asset and the momentum indicator are moving in opposite directions. Simple, are moving in opposite directions. This divergence can signal that the current trend is losing strength. And I have to put another line below this because it's really important. So when you have a difference in behavior between this and this, momentum and price, this divergence can signal that the current trend is losing strength and that a potential reversal may be. Because it may be, happening, but it may not, because somehow, I'll tell you something. If you know anything about the markets, and if you know anything about me, you will know that I will never tell you something with 100% probability or 100% confidence, because markets can literally do anything. We have scenarios when you have an uptrend, prices are losing steam. You don't just sell short and say, okay, I have a momentum divergence, prices are not able to continue, prices will reverse, because no, maybe the other day investors or traders will enter the market again in the same direction with renewed enthusiasm to buy. So you can sometimes have false signals, a lot of them actually, and that's why you can never work with this indicator or any other indicator alone, because you will need to know what's happening generally in the market. So when you have a momentum divergence, it's something really important to note and to act upon if other conditions are met. There are two types of divergences. There is a bullish divergence, and the word bullish means that prices will go higher, right? It's bullish. So it indicates a possible reversal from downtrend to uptrend. So when you have a bullish divergence, prices will be reversing from a downtrend to an uptrend. And the other way around is if you have a bearish divergence, prices will be moving from higher to lower, from uptrend to a downtrend. Let's have a look. This is an example of a bearish divergence. Believe me when I say, believe me, I don't even remember what momentum indicator this one is. So you have the price and you have the momentum indicator, right? When I was preparing the presentation, I just used anyone, because the idea of divergence, as I told you, could be applied on any momentum indicator. So the name is not here. I don't even remember what momentum indicator this is, but it will still serve our purpose to explain this. So what's happening here in price? So prices were basically moving higher, right? And then started to move lower. So some sort of reversal happened here, right? I think I need to, I'm not sure how can I do this. Okay, not now. Yeah, let me decrease this a little bit. Yeah, like this. Okay, so prices were moving higher and then we started to move lower. Some sort of, resistance or supply zone or whatever it is happened here, and we were moving lower. Could we have anticipated this move lower before it even happened? Yes, as I told you, because momentum divergence is a leading indicator. If you check the price, you will see that this was a normal upward trend. So you have higher highs and higher lows, right? So prices here formed a high that was higher than the previous high, because that's an upward trend. If you look down on the momentum, you will see that this high, which corresponds to this high, is lower than the previous high, which corresponds to this previous high. So this is how you know that the behavior of the indicator and the prices are not the same anymore, because prices are moving higher. We are still creating higher highs and higher lows, but on the momentum, it shows that simply the momentum here was lower than the previous momentum. This means that even if prices are moving higher, momentum in this last move was lower than this move. And this can mean, it's not a should, but it can mean that prices may move lower. And this is exactly what we started seeing here, moving lower, because the momentum was early to tell you, okay, wait, momentum on the second high is lower than the momentum on the first high. And this is a bearish divergence. Okay, guys, we are still in the theoretical part we will have many examples on the chart when we get down to the practical side, okay? What's a bullish divergence? It's the other way around, 100% other way around, okay? So here, and by the way, when I always get to you some examples from the chart, I don't focus on getting you the best examples. I always get you examples from the markets, the recent market, examples. So if you actually follow me in the weekly market analysis, what I'm going to explain right now on this chart, this is the DXY, this is the dollar index. We actually traded this upward move because of divergence and because we had another demand zone. So this is exactly something we have, and you will have it on YouTube, okay? What's happening here is that prices are slightly moving lower because this high is lower than the previous high, lower than the previous high, lows are slightly getting lower. So it's a downtrend, a slight, very slight downtrend, right? And what do you have on momentum is that this high, this low was a little bit higher than the previous low, and this low was a little bit higher than the previous low. So although prices are moving slightly lower, momentum is moving slightly higher, and this is when you know that the downward trend in prices is not followed by a downward trend on momentum, and this is when you have a bullish divergence. So in the best scenario, if you already have a demand zone here, let's say, and you have divergence, you will know, okay, we have divergence, which is a bullish divergence, and we have demand zone, okay, let's buy. And this is exactly what we have done in the weekly live analysis session, okay? So that's the bullish divergence. Prices are moving lower, and momentum is not able to move lower. So you know that, okay, we will be turning somewhere near, okay? And very common mistake that I find people do when trading the divergence is that, okay, we have a bullish divergence, I'll just buy. No, as I said, prices will not, it's not a must, it's not 100% probability. But when you have a bullish divergence, the best thing to do is to wait for prices to reach a strong support, because when you have a strong support here with bullish divergence, now you have double confirmation that, okay, prices most probably will not be able to close below the support and continue moving lower, so maybe we will be turning around. So as I'm telling you, that's why it's powerful, really powerful, to have this combined with the supply and demand, okay? We have spoken about the momentum itself, generally the idea of momentum and the speed of prices and so on. We have also discussed divergence. As I told you, divergence could be applied to any momentum indicator, but today we are here to discuss a specific indicator, the squeeze momentum. What is the squeeze momentum? So the squeeze momentum, to be honest, it's a very complicated indicator, okay? I'll try my best, to make it very easy for you. A lot of the details you don't even need to know. I'll tell you if you want, but I mean, while using it to trade, you don't need to know all of this information. But I'll tell you just, for the sake of, because maybe someone will need it. So it's a complicated thing, but squeeze momentum was basically developed by a trader who's still alive. I think this trader, I cannot really remember his name, but I think he made somewhere around $20 million of profits only in the year 2020, COVID time. He made 20 million profits, $20 million in profits. I don't remember his name, but I remember his bank account because it was wow, like $20 million. He's a really powerful trader. Okay, this guy, he didn't really invent something new, but he combined two already existing indicators, and he looked at those indicators in a new way, and he figured out that yes, okay, here might be an opportunity to look at momentum in a new way. What are the two indicators that he used? It was basically Bollinger Bands. If you know anything about Bollinger Bands, just leave it in the comments section. And he also used the Keltner channels. So both indicators are basically volatility indicators. It's not momentum. They measure volatility in the markets, and I will tell you exactly how. But he looked at those volatility indicators in a way that, okay, this might be a momentum indicator, okay? Squeeze momentum is an indicator that utilizes the relationship between two other common indicators, Bollinger Bands and Keltner channels. Through studying both those indicators together, we can measure how fast price moves relative to the normal average. How fast price moves relative to the normal average. So this is how he looked at those two indicators, and okay, he said there are some conditions. If this happened, prices are moving fast. If it didn't happen, we are not moving fast. So he basically started to measure momentum in a very, very creative way. And through closely monitoring the speed of price changes, we can successfully measure momentum. Okay? Starting from here, if you're really technical analysis nerd or geek like myself, you might need a pen and paper, because I will be telling you exactly how to calculate it when it comes to the calculations, but I don't have it on the slides here. This is the first indicator, which is the Bollinger Bands. Quickly, what is the Bollinger Bands? The Bollinger Bands is a volatility indicator. Very simply put together, you can see that when prices are not doing anything and just moving sideways, you will see that the bands are basically close to each other. So those bands contract together when price moves are slow and we are not doing anything, okay? And in cases when we have a strong move, a fast move, and a powerful move, you will notice that the bands get very wide from each other. So the distance between the bands here are very much higher than the distance between the bands here, because they expand and contract based on the price moves, how fast prices are, and how volatile this market is. So it's a volatility indicator. How do we calculate the Bollinger Bands? You will see three lines, right? The upper band, the lower band, and the middle band, or the middle line. This middle line is a 20 SMA, a 20 simple moving average. It's a moving average, a simple moving average for the 20 candles or 20 periods. I think most of us know the moving average, right? So that's a moving average. The upper band, we add something called the standard deviation. And if you don't know anything about standard deviation, you'll have to excuse me, because we will have to explain this. It will take a lot of time, to explain it. Maybe not today, but we add two standard deviations to price to have the upper band, and we subtract two standard deviations from the moving average to get the lower band. So simply, the Bollinger Bands is a moving average in the middle plus two standard deviations minus two standard deviations, and we have our band that follows price, because moving average follows price, okay? The Bollinger Bands itself as a separate indicator, and excuse me, John Bollinger, who actually created this, I never found it any useful alone as a separate indicator. It's not so good, because as I told you, I'm not so much an indicator fan, because in order for the bands to react to markets or the prices, they will have to wait for prices to move, and then they move after prices, because as I told you, it's a lagging indicator. Anyway, that's the Bollinger Bands. How about the Keltner channels? You will see it's somehow similar, just a different way of calculation. So again, we have a middle band, we have an upper band and a lower band. The middle band is a 20 EMA. So instead of a simple moving average, it's an exponential moving average, and the difference is slight, okay? Just another way of calculating a moving average. It gives more weight to the recent price actions, okay? The upper band is, we add 2 plus 2, but not standard deviations, but we add 2 ATRs. And the lower band is that we subtract 2 ATRs. What's the ATR? The ATR is the average true range. Quickly, as I told you, if you want to write this down, okay. If you don't want to write it down, it will not basically affect how you use the indicator. But the ATR is the average of the true range. Okay, so we have known it's an average. What's the true range? The true range is the highest value between the following three. Either the difference between today's high and today's low, or the difference between today's high and yesterday's close, or the difference between today's low and yesterday's close. The highest number between those three is called the trading or the true range, and by time we'll get the average of the true range. If you basically understood this, very good. If you didn't understand it, that's why I said it so quickly, because you don't really need it so much. Does anyone want me to go into those details of the calculation? If yes, I will do it. And I can even write it down for you to write it down. But I mean, the calculations are out there anyway on the internet. You can get it. But I'm telling you that I want to be more practical. I want to tell you how to use the indicator, not how to calculate it. Hi, is it possible you can send the recording? Not now, because we are still recording. I mean, I'm not sure if this will be recorded or not, but hopefully it will be. So we have the Bollinger Bands, as we said, the middle line, 2, it's 20 simple moving average, plus 2 standard deviations, minus 2 standard deviations, we have the Bollinger Bands. As for the Keltner channel, we have the middle line, 20 EMA, exponential moving average, plus 2 ATRs, minus 2 ATRs, and we get our bands. How did this guy who created the squeeze momentum look at those two indicators together? This is what he actually studied. And as I told you, it might be a complicated thing, but yeah, he has done the really hard job to make our life easier. He basically studied the relationship between price, between the Bollinger Bands, and between the Keltner channels to somehow figure out something. And yeah, if you are afraid that this is the squeeze momentum indicator, it's a yes and a no. So yes, I mean, because I know how the squeeze momentum is calculated, I can figure out when the signals are given here. But no, we have made it much easier. And using this, you know, complicated chart, we were able to formulate and write down a code that gives us this indicator down here. Okay, I'll tell you something. I think it might be time here to start checking the charts, because any more than that, you know, it will be just a waste of time. So this is a chart of, let's get any price chart. This is the New Zealand dollar, right? You have the Bollinger Bands. I'll need to add them all. So that's the Bollinger Bands with its basic entries or basic, you know, settings, nothing new. We have the Keltner channels again, and I think I will have to, you know, separate between the colors, because I'll tell you exactly what. Let me do the Bollinger Bands all in red and all in, you know, thick colors. Okay, So the blue lines are the Keltner channels and the red lines are the Bollinger Bands. This guy who invented the squeeze momentum, he didn't basically study the relationship between price and the indicators. He basically studied the relationship between the indicators themselves, and he just disregarded price. So if I completely remove price here, what you will notice is we have two indicators, right? He said something very simple. When the Bollinger Bands, which are the red lines, are so close together that they are inside the Keltner channel, like this part here, so you see the red lines are inside the blue lines, this means that the momentum is weak. We don't have momentum. Prices are so slow, they are doing nothing at the moment. Okay, and on the other hand, if the Bollinger Bands are out of the Keltner channels, like this situation here, this means that prices are moving fast with powerful momentum. Okay, that's good. That seems good. Do we need anything else? No, we don't. Let me just do something. Let me get back the price. And you have understood, the basic idea of the momentum and how we calculate it using squeeze. And now let me add squeeze momentum. And for you asking about the squeeze momentum, so I use TradingView. It's there on TradingView. You can just open indicators, you will find it. Once you write down squeeze, I have it here in my favorites. You will have many squeeze momentum indicators, right? But the one I use is by someone called Lazy Bear. He actually programmed this squeeze momentum into TradingView for others to use, and it's free, even if you don't have a subscription on TradingView. Even more, if you want to have the indicator on MetaTrader 4, you will just need to send me an email. I'm typing down my email right now, because with the help of a programmer, I have managed to code down this indicator on MetaTrader 4. I don't use it because I don't personally use MetaTrader to trade or just execute my trades. I don't use it to analyze, but I mean, you have it either on TradingView. If you're not into TradingView and you want MetaTrader, just send me an email that, okay, please send me the file for the squeeze momentum for MetaTrader. I'll reply back with the file. You will just put it inside your MetaTrader and you will have the indicator. This is squeeze momentum. The squeeze momentum can be used in many ways. Okay, first, you will see that, okay, first of all, you have two colors, either red or green. I know some people who basically sell when the colors turn red. So let's say it gave you a sell signal here. It started to go red. When prices were correcting a little bit and prices and the momentum went again red here, it's another sell signal, and you actually hold the sell signal till maybe here. That was a full signal. So yeah, somehow like MACD, because if you use the histogram on MACD, if it's red, it's a downtrend, you just simply sell. If it turns green, like maybe here, so it's a buy signal. Here it's another buy signal, and so on. But no, I wouldn't really recommend you use it in that way, because it will just give you lots of false signals, right? That's the first thing, the first use. The second use is, if you can notice here that there is a difference between the strong green and the light green. The strong green is a powerful, strong uptrend. When it loses momentum, you will find it, getting a little bit lighter color. until it turns red or continues again. So a strong color, green, means a strong bullish trend. A light green color probably says that you should stay out. And the other way around with the red color. A strong, thick red color or dark color means it's a powerful downtrend, and when it loses momentum, you will just see it losing momentum. Again, this is another use. I don't really like it. How do I really use it? I use momentum indicators like squeeze momentum only with the divergence. Look at this. Prices are moving higher, right? Higher highs and higher lows. So this is an upward trend. Let me just... Prices are moving higher. Does this mean that this upward move will continue or not? They say the trend is your friend. Should I buy with this friend, or should I wait for it to, to reverse? If you look at the momentum, you will simply see that as prices were basically moving higher, momentum was basically moving lower, even before prices started, So yeah, this is what I'm talking about. If we just, disregard the prices, I still don't know that prices went lower, but I mean, yeah, this here shows that prices are moving higher while momentum is moving lower. This is what we explained as a divergence. Only then you will be starting for any sort of resistance here, previous resistance, or as I told you, if you use supply and demand, you will know that maybe if there's supply here, look at how this price went lower so much. Okay, I need to get examples from you. Tell me which chart you want me to look at. So that was an example on a bearish divergence because prices went from higher to lower. I want some example on a bullish divergence. Bullish divergence, that's the example we explained already on the dollar. I want some bullish divergence. Get me, okay, that's a bullish divergence here. Simple. It didn't take me long. It's the pound versus the dollar. And you can see this downward trend before moving higher. Let's see if there's some sort of divergence here. Can you write down in the comments? Type yes if you see a divergence. Type yes if you see a divergence. And type no if you don't see. I'm using divergence and Dominion break. Very profitable. Good. Very good. So yes, you see a divergence because yes, there is. Definitely. So where's the divergence? You can see here. Prices were moving lower. Let's say that's a low, a high that's lower than the previous high, and that's a low that's lower than the previous low. Or even if we want to go more focused with this downward move, so that's, lower lows and lower highs. And you can see that as prices were moving lower, we were able to form lower lows. However, momentum didn't agree. And this low that somehow or nearly corresponds to this low is way lower, right? You can see there is something wrong with price. Prices are moving lower, momentum is moving higher. Thank you so much. We are not buying this. So that's a bullish divergence. Someone said the pound Japanese. Where's the pound Japanese? Let me look here. Okay, I'll tell you something. You must know that not all of the divergences you will act on. Right? Why is that? Because simply, if something is moving because of a fundamental issue, it will not respect momentum. But anyway, let me try. Yeah, there is definitely a divergence here. Prices were moving lower. Lower lows and lower highs. You see what's happening here? That's a good example, by the way. Prices here basically formed an equal low, right? It's not a lower low, it's an equal low. Still, momentum showed that, okay, it's a slightly higher. I mean, it's not a textbook example because it's not, you know, a lower low on price while momentum is moving higher. No, momentum is moving higher even if prices are moving in a sideways range. So it's still a divergence because still prices are not following exactly, or the momentum is not following exactly what's happening with the prices. What else? Simple. You see this one? Again, equal high, momentum is showing lower high. That's a good example, by the way, because it's a pound yen. There is supply here. Let me see if we can. No, this is not supply, unfortunately. Let me see if we can. Yeah, let's say this is a base candle. And guys, if you didn't attend the supply and demand, you can find it on our YouTube channel, PU Prime. Look at this. Look at this. So that was a supply, right? Here, powerful supply. We draw the supply zone here, and here when prices are actually moving into the supply, this is hard to see, but I really hope you will be able to catch it. You see this high, this exact high. Prices tried moving lower. We tapped into a slightly higher high. But if we draw and check what momentum was doing, you will see that as prices were trading nearly in the same level or even slightly higher level, momentum was way lower. So we have, this is a perfect example of what I personally would trade. I didn't basically trade this pound yen because I don't trade the pound yen recently, but this is a perfect textbook example of my strategy. This is a supply zone, right? Perfect supply zone, perfect bearish divergence, just short, and thank you so much. We have seen this downward move, and even here after this downward move, prices are moving here lower lows while momentum is moving higher. And yes, there is a demand zone here. See this powerful candle? It's a powerful demand. When we came back, but as we approached the demand, momentum said, I have a bullish divergence. Boom, went back higher. Boom, again, bearish divergence before moving lower, and so on and so forth. Do you guys see how powerful this is when used with supply and demand? Don't use it alone, because if you use it alone, because it will give you false signals, a lot of it. But using this with the supply and demand, it will be really powerful. Sir, how about USD in 1 week, bullish or bearish? That question should be asked in the weekly analysis session, but yeah, let's try to see. Yeah, this is a bullish divergence here, and this is why we bought the dollar, I think 2 weeks ago. That was around here, and it's in the live session. This is the example I had in my presentation, by the way. It's bullish, it's bullish. We are just waiting for a retracement and a move higher. Okay, now something really important. We have spoken about the divergence. What is happening here? What's happening here is a convergence, because see, you see this high which we're currently trading around? This is the high that we have on the momentum, right? Oops, what's that? Okay. This is the high that we have on the momentum. Is it higher than the previous high? Where is the previous high? It's here. So the momentum is somewhere around here. Yes, it's high. So prices are moving higher. Momentum is moving higher. So yes, this is not a divergence. This is not a discrepancy between the behavior of price and momentum. It's actually moving together. So it's a convergence. Again, why is that? Okay. So yeah, please let me know if you want more examples. Please let me know if you have any questions, because I'm almost done here, but I want to make sure that everything that I've explained is basically well explained. I have an email here already, a lot of emails requesting, good day, could you please send the file with the indicator for MetaTrader? Could you please send me $200 for it? Okay, I will. Whenever I'm done with this session, I will send you the indicator, okay? Something I really want you to take care of, which is, I have tried my best to simplify this for you today in this webinar, but there are some things that you need. Okay, I'll tell you something. Imagine that you are learning to design, or you're learning, you know, to be a graphic designer. What I've done today is that I've opened the Photoshop or any, you know, Illustrator program, and I've taught you the tools. So this brush is used for this task. This rectangle is used to draw, and so on. I've taught you the tools. However, in order to be a good graphic designer, you actually need two things: time and practice. So you need to go open the charts or open the Photoshop. You get my metaphor. You need to try this. You need to see it, and you need to apply and practice what you have learned today. So it's not something that it will just, you know, come into effect immediately. It needs practice and it needs experience, and that's why we have the weekly analysis session, where I basically, I literally do my analysis on the session using the squeeze momentum and the supply and demand, nothing more. By the way, I never even thought about giving this webinar until the guys who actually attend with me the supply and the weekly analysis webinar requested, okay, you talk a lot about supply and demand, how about you do a session for us? I answered, and I've done the supply and demand session. Now we went a little bit further, because supply and demand cannot go without, you know, the squeeze momentum. It's perfect fit together. So, and that's why I'm, you know, explaining to you how I actually work. If you want to practice, join us in the weekly analysis webinar, where we analyze the markets on Monday. Every week. We have been doing this since, I think, February or March, non-stop. Every week we have this session, and you will be able to catch, okay, now Mohammed is talking about, you know, some sort of a bullish divergence near demand on the dollar, that's why we bought, and so on. You will learn by practice, and you will learn by seeing this. What's the best time frame to use this indicator? Mahboub, this is the worst. This is the most question I hate after any webinar, because my answer is always the same. It actually works on all of the time frames. However, the larger the time frame is, the better. Of course, technical analysis is actually created for the longer time frames. It's not created for the 1 hour or the 1 minute or the 5 minute time frames, because technical analysis is a study of the price action and the behavior and the psychology of market participants. Do you think you can read the behavior of market participants better on a 1 minute time frame at 12 a.m. New York time, for example, or can you read it better on a weekly time frame? Of course, the weekly time frame. It gives you a lot more data to analyze. It gives you weeks of behavior and price action to study. But on the 1 minute time frame or the 5 minute time frame during the day, on a non-volatile day at the end of the week, what sort of price action are you studying? That's the whole point of technical analysis. So you will find me, it's the same answer. Whatever the technical analysis indicator I'm giving you, or strategy, or whatever it is, the higher the time frame, the better it is. And just as a rule of thumb, don't use technical analysis on anything lower than the at least 1 minute, 1 hour or 30 minutes. 30 minutes time frame is the lowest I personally advise you to use. Lower than the 30 minutes, you are just on a gambling table. With all the respect to any out there, any guys out there who scalps the markets profitably. Yes, you can do it once, twice, 3 times, 10 times. You cannot do it for a lifetime. You cannot do it for a full-time job. That's my point, okay? Do you have any questions? I think we are good. Let me check the email one more time. Okay, I think we are done. Guys, again, if you want the squeeze momentum indicator, I've sent you my email in the chat. And please send me an email just requesting the MetaTrader indicator file, and I'll send it to you right away. If not today, will be definitely on Monday, because today is already Friday, it's already 5 p.m. So yeah, thank you, sir. You were really good at explaining this topic. Thank you so much, guys. I must thank you for attending this webinar, because I know, of course, you have a full-time job, some of you are married, you have other things to do. However, you left everything to attend this webinar. This definitely says something about your will to be a successful trader. So thank you, and I really hope that every one of you actually reaches what he wants in the trading career as soon as possible, ASAP, because you all guys deserve it. As long as you left what you should, any one of you has another thing that should be doing at the moment, right? And you left it to attend something, to learn something new about trading. And that's why I really find the responsibility really huge for me to try to teach you something. I respect your time and I respect your presence, and I hope that I'll continue to do my best anytime to support your trading career. You guys all deserve the best. I don't know why I got so emotional, but okay. Thank you, guys. I think I'll have to go because I have a weekend that should start. I'm done. That's the end of the week. It has been a tough week. Guys, I'll meet you on Monday on the weekly live analysis session. Please make sure to follow the email if you want to register for it. And yeah, let's meet on Monday. Let's have another trading week, a successful trading week, hopefully. And I will meet you guys on Monday. Thank you so much. You have a great weekend. Goodbye.